There are many ways to see how imbalanced the Chinese economy is, which the leaders have been talking about for quite a number of years, since at least 2007. But I think the most salient manifestation of the imbalance is the fact that the consumption share of GDP is the lowest of any country in the world. Indeed, it's the lowest of any in recorded history for all the countries for which we have data. And the counterpart of that, or the flip side of that, is that the share of output that's being devoted to investment is unusually high. It is completely outsized. No other country has ever invested as large a share of GDP as China has the last 7 or 8 years. So that's one manifestation: low consumption, high investment. Another, at least until recently, has been that China has had a very large external surplus, much larger than any other significant trading economy. It's begun to come down in the last 2 or 3 years. But in the course of having many years of a large trade surplus, they have a very, very high level of foreign exchange reserves, higher than any other country in the world, which has certain downsides. It subjects them to certain foreign exchange risk and makes the conduct of monetary policy more difficult than it would be if they had a more balanced pattern of trade with the rest of the world. There are a number of reasons that the share of consumption is so low, but I would highlight the fact that real deposit rates for savers are very low. So if you put your money in the bank, it actually loses value. And that means people's income is lower than it would be. So the first effect is this negative real interest rate, which depresses income. And if your income's lower, then your consumption's going to be lower. But the second factor is that as the real interest rate became negative starting in 2004, quite a few years ago, households actually started to save a larger share of their after-tax income. And I think the explanation is that most Chinese households are what we might call target savers. Their health insurance, if they have it, isn't very good, so if somebody in the family has to go to the hospital, they have to have cash to pay for it. So they have a certain amount of savings that they feel they need to be secure. And when the real interest rate goes down, it's going to take them longer to reach this target level of savings, so to compensate, they start to save more. And the level of savings out of disposable income, the share of savings out of disposable income, has gone up quite dramatically since 2003 or 2004. Almost 40% of the average Chinese household's disposable income goes into savings. The key policy change that they need is to make real interest rates positive. I mean, we talk about negative interest rates, but these are not market determined. The central bank, acting on behalf of the government, sets a ceiling that banks can pay on deposits and sets a floor that banks can charge on loans. And so the negative real interest rate arises from the fact that when inflation goes up, they don't raise the nominal deposit rate, so the real rate becomes negative. And so when inflation rises, they should more fully raise the nominal deposit rates so that they keep the real interest rate, that is, taking into account inflation, they keep that in positive territory. And Chinese authorities have admitted that if they were to go towards more market-oriented interest rates, that deposit rates would rise quite substantially. So gradual, not overnight immediate elimination of these interest rate controls, but a gradual widening of the bands that banks are allowed to charge on loans and the amount that they are allowed to pay on deposits would be the most obvious policy instrument to get people's incomes to go up and for them to feel that they have enough financial savings to deal with contingencies. There are other things they could do. They have been doing. They need to build out the social safety net further so that some of the self-insuring that people are doing as individuals could be handled through insurance schemes that are operated by the government or the private sector. Those have begun to be developed in the last 4 or 5 years, but there's a substantial additional amount that could be done to build out the social safety nets, so not everybody has to completely self-insure, which tends to drive up the savings rate.